All right. Well, hey, just to respect everybody's time, we'll just go ahead and get started. I'm sure more people will join, but the more the merrier. We got 100 seats here. So, well, hey, for some of you, most of these faces I know. There's a few names I don't. So you may have been invited by Paul or Stephen or somebody else who forwarded you the link. So thanks for joining. Hope you had a good day, and can relax this evening with everything going on. But hey, I'm Dave Beffert. Just putting this together. I'm trying to do just weekly get-togethers, weekly discussions with people about all topics money, all topics financial. I spoke with Stephen Libman here earlier this week. In fact, Paul Fougere, there in the ugly Boston sweatshirt, he and I are spoke with Stephen earlier this week, and wanted to bring him on and just talk to people about apartment investing. And I met Stephen a couple of years ago in a mastermind group I was a part of when I was doing single family flips and wholesaling. And Stephen was doing the same thing, and then he moved on to apartments, so doing some syndications now, which I've been wanting to get into for a while now. So I'm really interested to hear about your business and how you work with investors and how investors work with you, and what they can expect if they work with you and invest in one of your apartment deals. So with that, I'll just turn it over to Stephen. He'll tell us a little bit about his business and how he works with investors. And if you guys have any questions, go ahead and I don't know, Stephen, you want to take them live, or do you just want to, we can hold them until the end, and you can take them there or type them in the chat box?
Yeah, I mean, I think we have a small enough group where if you guys wouldn't mind just typing it in the chat box as they pop up, and then when I take a breath, I'll just kind of look at them and see, depending on where you're at in life, you probably have different questions. How we got started is usually the question that a lot of people get into. And then also now more granularly, like, are your people paying rent because of the virus, right? So anything and everything is fair game for us. We just want to be able to help and add some value if we can. So yeah, so we own a company called Integrity Holdings Group. We are based out of New Jersey. We own nothing in New Jersey because it's a good place to flip, but it doesn't create a lot of value via cash flow, right? New York and New Jersey the cost per door is high, the cap rates are low, so it doesn't give us a high yield return on investment. So we flipped houses for about 10 years. At scale, we're flipping and wholesaling about 20 deals a month. So we were on track to do almost 250 deals. The business was good. It was a multi-million-dollar business, and we have since shut it down. And the reason for that is because it's a very transactional job. It's a high-paying, highly taxed job. And we always knew that we wanted to move into something a little bit more passive, right? So everybody here have read Rich Dad Poor Dad? Yeah. So no, if you haven't, you got to, right? It's not a tough read, but it's a good one. I read that book right out of college and kind of knew I wanted to work for myself, and I thought real estate would be a good way to do that. So we started wholesaling. We did that for about 5 years. We joined a mastermind after that 5-year period of time, which was really the shot out of the cannon that let us grow and scale. But it was not hands off, right? I was still working, not insane hours like we were when we started, but I still didn't see a light at the end of the tunnel. Like, how was I going to retire? And we started getting around some mentors and listening to some podcasts about more passive investing. And I thought, we had a good model here to buy cheap houses in New Jersey. But even then, the single family rental model was difficult for us to figure out how to scale and manage without being full-time in the business all the time. So as we started to learn and grow, we recognized that large scale apartment complexes were the way to go. And we already had investors that had invested with us on our single family flips. So we had a couple $1 million of private investor money that we knew we could pay better returns than what we were paying on the single family stuff, tax free, because the tax benefits in multifamily and commercial investing is unlike any other. If you haven't read the book by Tom Wheelwright called Tax Free Wealth, you should read that. It's a whole book about the tax code that I promise you'll be excited about. It's the first time I ever listened to a book about taxes where I was psyched. So um, outside of oil and gas investments, commercial real estate investments offer some of the most tax advantaged returns of any other asset class. So this year we will buy somewhere in the vicinity of $50 to $75 million worth of assets, and we will make well into the seven figures, and I will pay zero taxes. I will pay some state tax. So that's only a federal tax rule, but I will pay some state tax until I leave New Jersey, which I'm sure will be soon enough. So that's what we always knew. We knew we wanted to get into some passive investing, start building retirement, building generational wealth, and actually understand where my money was coming from. So I run a podcast called Free from Wall Street. These guys were kind enough to join me on that call this week. We talked a little bit about some of the strategies that they're using that I also use, which is the infinite banking concept. And these guys can kind of chat with you about what that looks like. But from a business ownership perspective, there's no better vehicle for me to save money for retirement and then leverage that money into the deals that I want to do myself without blowing up like a 401k or an IRA, because it's a vehicle that as a business owner I get to use and doesn't have those arm's length transaction restrictions. So that's why we like that. So last year we bought about $75 million worth of property. Our first deal was about 18 months ago. It was a ground up construction project of 1,193 self-storage units. So over 130,000 square feet of rentable space. It is open for business. We are renting out units. CubeSmart is the third largest REIT in the country. They manage the property. So they're not, they're branded on the side of the building. So it doesn't say like Steve's Storage. It's a CubeSmart building, and they're basically acting as the third party manager, right? They have a person in the office that rents wearing CubeSmart shirt, and they give us all the reporting at the end of every week and month on the financials. So they're just acting as a third party manager. We're paying them about 4.5% to do that. Since then, we've started construction on self-storage facility number 2 and number 3, all in Orlando, in and around Orlando. And then we bought a student housing complex. It was about $10.5 million, 867 bed student housing complex in Iowa. And currently we just recently closed on 66 units in Columbus, Ohio. We are also under contract on 220 units, 84 units, 140 units, 192 units, a 99 unit, 97 unit. It adds up to about 861 units that we're currently under contract on. All of those have kind of hit the pause button during pandemic season. It's actually it's a real blessing for us because we're in our due diligence phase. So we don't have any money hard. We don't have hard closing dates yet. Everybody kind of understands what's going on. So once the world turns back on and gets back to work, we've dictated economic vacancy floors, right? So if it's economic occupancy is how many people are paying rent. So you could have physical vacancy of 90%, but if a bunch of those people aren't paying rent, you could have economic vacancy that's higher than that. So we have economic occupancy floors on all of our contracts, meaning if they dip below 92%, we won't close. So that's good for us because once everybody gets back to work, they'll take a month, they'll get that economic occupancy back up, and then we'll go close. So that's kind of what we've been able to accomplish in a pretty short period of time here. We'll have about $150 million of assets under management by the end of this year. And, we've been syndicating. All syndicating means is many hands make light work. So I can't go buy a $10 million building by myself, but everybody on this call can pool capital into a SEC regulated investment. And then we can all reap the benefits of that investment. So what we do a little bit differently is we bring on investors to invest with us. We put them in what they call a preferred position, meaning they get paid before I'm allowed to take any money as an operator. So what it does is it kind of sets the floor to the investor so they can kind of know what they're getting, right? We had a lot of investors that were with us that were paying 8 to 10% to in our fix and flip business. And we took that same model and we moved it into into the commercial space. We're paying them higher returns. They get significant tax benefits too. And then we send them quarterly checks. So every deal's a little different. Like the new construction projects didn't have any distributions in year one because it's under construction. There's no asset there yet. Most of the cash flowing buildings that we're buying, they're able to cash flow right away, and they're making quarterly distributions right away. So that is how we're working with investors. It's a real interesting process, educating people that, one, they can do this. A lot of people don't know, and that's what the Free from Wall Street podcast is all about. A lot of people don't even know that they can directly invest into these things without a financial advisor involved, without Wall Street being involved. And that's because it's relatively new, right? It started in 2008 with the Jobs Act. Before the Jobs Act, this wasn't really available to people. So the Jobs Act opened it up to where people were able to directly invest. And the only caveat now is you need to know guys that are buying those buildings, right? So once people can meet with us and they talk about what their investment goals are, then we can kind of lay out what those projects look like. And typically we're buying buildings that have existing cash flow, but they're typically under market rent by somewhere between 20 to 30%. They're going to need some capital expenditure on either some exterior, some interior, depending, right? Every deal is a little different. One of the deals that we're doing right now only needs $400,000. It's all exterior work. The current owner has already turned all the units. So they all have new cabinets. They all have new floors, doors, trim, bathrooms, appliances. So there's upside there without a ton of capital that needs to get spent. And there's others that are heavy lifts where we know we're going in there, we're buying it pretty cheap. And every time a tenant moves out, we know we're going to go in there and we're going to gut the whole unit and start from scratch and then bump the rents that way. But so for our multifamily space, that is kind of the model that we like to use: existing cash flow so that we can get good financing on it, 10-year term financing, and then also some value add to it, meaning it's under market, it's mismanaged, maybe the expenses are too high, things like that. And then over a 5 to 7 year period of time, which is our typical hold, then we'll increase those rents and decrease the expenses. And what I like about commercial is that it's all based on that controllable net operating income. So if you can increase income and decrease expenses, that's how you create value in commercial. It's not like the residential space before, when we were looking at comps of the neighborhood and saying, well, this is about the price per square foot that I can get if I renovate this property. Net operating income is going to be market specific. What's the cap rate? And then because it's controllable, you can kind of see with a pretty clear picture where that property is going to go. So that's kind of why we moved into that space. And again, the tax benefits are pretty significant. And 6 years ago, my dad passed away, and he lost about half of his wealth that he had in the stock market. And he was already retired, so he wasn't in real volatile funds, right? He was in pretty safe and secure mutual funds. Nobody saw the crash coming, just like this one, right? Nobody saw a market correction taking place until they were in it. And he ended up losing 40 to 50% of his wealth, and then he passed away. He didn't get to ride that market back up. And it made me take a real hard look at my business model, made me take a real hard look as to how I was going to have some control in my retirement and kind of create predictable, consistent returns. And the way that we found to do that was through these large apartment complexes and self-storage facilities, because we know, based on kind of what's going on in each one of these markets, what we can expect for rent, what's the best and worst case scenarios, right? And it's a real tangible asset. Even before this virus took place, right, I was always saying, if somebody can tweet, right, if the president can make a tweet that tanks the market, I don't want my retirement there. So we really needed to take a harder look at what's a real asset, how can we figure out how to get involved in that asset and control that asset, and then create that generational wealth and stability that we were looking to do. So that's kind of the why behind it.
Stephen, how about, so I've been wanting to get into apartment investing. I've never done it before, but I definitely want to get into it. If I came to you and said, hey, I'm interested in doing this, what's the process from A to Z on working with you? as an investor, and what's in it for me.
Yeah. So it's deal by deal, and it's operator by operator. So the big questions are, how are we finding our investors, right? Mostly it's friends and family, right? People that we have existing relationships with. And here's the two things you need to know about how the SEC allows you to have exemptions. Number one is you can do a 506B, which is Bravo, or a 506C, Charlie. The C's, I can talk about my deals and my returns on this call, right? I can tell everybody, hey, we have this deal, we're raising for it. These are the expected or projected returns for this deal. Call me after the call and we'll get you involved in the deal, right? The 506Bs are more private offerings, right? So the SEC allows me to have what they call unaccredited investors into that deal. So the 506C, I can publicly say, hey, come into my deal, here's the projected returns. But the requirement is they want you to be what they call an accredited investor. An accredited investor is somebody with $1 million in net worth outside of their primary residence, or making $300,000 a year for the last 2 years, with a good expectation to do that again this year. So a 506B allows me to do unaccredited investors, which would be friends and family, people that don't have that $1 million in net worth, but they're sophisticated, right? So the SEC says, well, you're smart enough to deal with your own money, but you're unaccredited. So I'm not going to be able to blast out my deals to everybody, to unaccredited investors. I need to have a pre-existing relationship, or what the SEC calls a substantive relationship. So there's a cultivation period that goes into it if we're doing a 506B, so that we can take those unaccredited investors in. So what that typically looks like, right, is a couple of phone calls. We're going to talk about finances. We're going to dig into what your goals are. We're going to talk about some of our past projects. And then when you say, yeah, hey, after hearing all of this, I do want to get involved in deals, right? So let's fast forward to that point. I just wanted to make the legal caveats about what that looks like. So let's just use the self-storage facility as the example, because that's already up, it's running, right? We've owned it for 18 months now. It was a $2 million purchase price for the land. The project cost $8.2 million to build. So we were in it for $10.2 million. Okay. So we got 65% LTV financing on it, and we needed to raise about $4 million. So we went back to our investors and we said, hey, Mr. Investor, we want you to be involved in this deal with us. You're going to get significant tax advantages just like we are. And most of those guys came from our fix and flips, where we were paying them 8 to 10%. That deal we structured as a 12% preferred return, meaning they were going to make 12% on their money per year for as long as we hold the property. Now we pay 6% along the way through cash flow. And then the other 6% is accruing to the back end. So easy math, $100,000 investment from an investor came in. They're getting paid $6,000 a year for 5 years. Payments are quarterly. And then the other $6,000 a year is accruing until we exit. An exit can be a refi or a sale. And then when we sell it, we give them their $100,000 back plus the other 30, right? The accrued 6%. So for every 100 they're putting in, they're getting about $160,000 back. And then we'll redeploy that capital into more deal flow as we continue on. So that's how that deal is structured. That was assuming that in year one we have cash flow. There was none, but that was ground up development. It's a little bit different. So that was accruing while we were building it.
Okay, yeah, that helps. Thanks for talking about the SEC stuff. I don't, I'm not up to speed on that, so I know there's a lot of rules when it comes to talking to investors about this kind of stuff.
And why they want to do that, right? I mean, it's pretty simple why they want to do that. I don't know everybody, right? And if I'm on a radio show claiming 12% returns and people say, well, grandma gave Stephen all of his money and he took it and ran with it, right? Then the SEC isn't doing a good job of protecting the consumer. And saying that I'm allowed to just go talk to everybody. So that's why they require that substantive relationship if you're going to do an unaccredited investors. But if you have people that are all accredited investors, right, and there's quite a few of them out there, then you can go out and you can talk to every single one of them. So I think it's an important topic. I know some syndicators that get really upset about how the SEC handcuffs you, but it's really to protect the consumer, right? I mean, anybody can just go in and say, these are the returns, and everybody will like it. So you have to just be aware.
Okay. And just to be clear, I don't need to be a millionaire to invest in some of these deals.
Nope, absolutely not. And that's what I'm saying. If it's my deal or somebody else's deal, then they'll tell you what the offering is, right? And they'll ask you some of the questions that we talked about before in that questionnaire. And um, my daughter is actually one of our investors, right? She invested $13,000 into one of my self-storage deals. She's 6. So that was all the money in the world she had, but she's invested into our, if you go into our YouTube channel, Integrity Holdings Group, you'll see a YouTube video called Millionaire Kids. And I go through the compound interest calculator with her on my lap, and we find out the day that she becomes a millionaire based on her investment into our self-storage facilities. So spoiler, it's when she's 37. So
Not bad. So 31 years. You said she's 6?
yeah, with only about, what is it? So I put $13,000 in her first 6 years. And then now what we're doing is we're putting $100 a week away for each one of my kids. So it's a $5,200 a year investment into my kids. So that calculates another $26,000 on top of the original $13,000, because I'm going to do it until she's 10. And then that 26 plus that 13 will turn into $1 million with nothing else added to it by the time she's 37.
Wow.
Just based on the returns that we're paying out to her. So Jack just shot out a question for us. Can you elaborate on tax advantages? Oh yeah. So, right. So how are we not going to pay any federal tax this year? And the IRS allows for depreciation, right? You're allowed to take depreciation on these assets. So, now that Greg Dickerson joined the call, I'm going to be checking myself and all my facts here, because he'll call me out on it, right, Greg? So commercial, I forget if it's 27 or 39 years what the depreciation is. Yeah, man, tighten it up, he says. Oh, man, he's right. So commercial real estate depreciates over 27 and a half years. No, residential is 27 and a half years. Commercial is 39 years. So let's just use easy math, right? A $10 million building, you'll get to depreciate that over a 9-year period of time, right? So you get $10 million divided by 39. That's your yearly depreciation that the IRS allows for. It's a couple $100,000, so it's significant. So it'll offset a good portion of income. Now, the IRS rules, especially under the Trump tax code, but this existed before the Trump tax code, allows for what they call accelerated depreciation, which means you can do what they call a cost segregation study, which is basically an engineering report that goes in and picks your building apart and says, well, we know that you can depreciate things over 39 years, but we also know that your carpets aren't going to last 39 years, right? They're going to last X number of years, and they apply a value to it. So it's a detailed engineering report talking about all the systems in the entire building, roof, windows, carpet, right? Everything. And the IRS allows for you to accelerate the depreciation into year 1 on some of those buildings, and it ranges. So depending on the building, it could range anywhere from, let's use the storage facility. We just took 40% of the cost of the storage facility in depreciation this year. So it was a $10.4 million project. So we got to write off $4 million of that 10 against real income this year. And we split that with our investors. So on that deal, the average investor, for their $100,000 that they put in, wrote off between $37,000 and $45,000, right? So that was the average between what they had in. And what can you use that to offset? Well, if you're a real estate professional like I am, you can use it to offset whatever your income is, right? So if I could write off $1 million, it means I can make $1 million and not have any taxable income, right? The typical investor, or a lot of our investors, don't do this full time. They're not real estate professionals. So Dave just jumped on here. David Scalise is a realtor here in New Jersey. He is a real estate professional, so he can use that depreciation against his ordinary income. Paul is not, right? He's still full-time military. So he can't use that against his primary income, but Paul also lends as a private lender. So that is passive income. So that depreciation can offset the income that he's making as a private lender over here, right? So it's some things that you have to find, number one, the right accountant for, right? And this is a time when you start to make passive income that you want an accountant to be looking at this stuff, not H&R Block. And, we're happy to send some referrals over to you guys of who we've used in the past. But yeah, this depreciation that gets to offset either your other passive gains or, your ordinary income, depending on if you're a real estate professional. A real estate professional, by the way, is just, it's a quantifiable way. I think you have to be doing real estate for 700 hours a year, and it's got to be your primary source of income. Right. So even if, when we're done with Paul, he's going to still be full-time making money from the Army, but he's going to be making more in real estate than he is in the Army. Right. So once that happens, then he can go talk to his accountant and say, hey, when do I become a real estate professional so I can use all of this depreciation to offset all of my income, which we'll get you there. Right. It'll happen soon.
Yeah, that's really helpful. Yeah.
So now what's even more interesting is in Tom Wheelwright's book, Tax-Free Wealth, he talks about the only thing that beats commercial real estate, and that's oil and gas. So dollar for dollar, if I was to put $100,000 into an oil and gas investment, the government allows us to write off $100,000 that year. Now, why would they do that, right? They were trying to promote local investment into American companies for drilling here. And the tax code is really a big book of how to not pay taxes, right? What people think it is the government telling you what to do. No, they're incentivizing you on what they want you to do. They want you in oil and gas. They want you in multifamily housing, right? They are incentivizing you to put your money where they want it to, and they'll give you huge tax breaks for that, right?
Hey,
So,
Steve, did you talk about the new CARES Act with the coronavirus about the net operating loss carry forward?
I have not.
So that's something to talk about, guys. I don't mean to thunderbomb your thing here, but with the CARES Act that was passed, you can now, there's a 5-year carryback for losses from 2018, 2019, 2020 moving forward. So that's definitely something you want to look into. Just Google that, the CARES Act net operating loss carry forward. And that's a huge tax break for businesses.
Yeah. So what that allows for us to do, right, is to look back a couple years and say, oh, okay, now I can take this loss and apply it to these. You're going to have to redo some tax returns, but they're allowing for some interesting additional tax benefits. And I'll email you kind of a breakdown or a video of that, Dave. I watched a really good one the other day. Well, Greg probably did a podcast on it by now, but
I watched the Tom Wheelwright one. I know he did one he's got one on YouTube about it.
Oh, okay, good.
No.
Yeah, so that's incredible too. So and what they're doing too in this CARES Act is they allowed people to go and take money out of their 401k. So we have a lot of people calling us right now saying, hey, I'm going to take that $100,000 out of my 401k because it's super volatile and I can't control it. Because there's no penalty, they're going to start investing it on their own now, right? And the payback period is 3 years, I think, to avoid the tax. I think I might have read somewhere that they might not even make you pay it back.
There's no payback requirement from what I can tell. I don't know.
But then it will be taxable, right?
It is taxable.
Now here's a question. Now here's a question for guys smarter than myself, and I'll just ask my accountant this. Now I wonder if that tax that you have to pay gets offset by the depreciation that you take.
Well, you could space the tax over 3 years too, so it's kind of nice. So I could take out $100,000. I'm waiting on, for the military guys, I'm waiting on an answer back from TSP. I got on the phone with them today, and they're still waiting on IRS guidance. But if the TSP is she's like, it's not really a 401k. It's a whatever she said. Anyway, but the point is, you can take $100,000 out of your 401k, and then you can spread that tax over 20, 21, and 22.
You're on a live thing
Right.
but
So
that's a
if you're
great.
getting refunds
One of those new
anyway,
things. I've never done it before. It's like 20 people on here, but Paul's one of them. I'm just listening. I'm not talking.
you are.
No.
Is
He
that
doesn't
Death
know he
Star?
is, but he is. Yeah.
All right, muted.
There you go. So that's interesting, right? Especially if you're getting tax refunds at the end of every year. If you have a W-2 job and you're getting a refund, right, then that can be utilized to offset those taxes that you're going to have to pay for your 401k. Because basically, you've just given the government a free loan anyway. I love it when people get so excited about their tax returns. I haven't had that in probably a decade, so I don't know what it feels like anymore. But so what else, Dave? What else can we cover here? Anybody else have some questions?
Yeah, anybody else have a quick question?
Oh yeah,
Yeah, I do.
Sarah just popped up on the chat box. I didn't mean to just step on her either, but yeah. So Sarah, the short answer is yes, and we're about to talk about that.
Yeah,
Okay,
and
cool.
I do too, by the way. So I started these policies for myself, my wife, and my kids. So my kids are now investing through their insurance policies as well. My wife
Cool.
as well. So
Yeah,
that's,
Stephen, I'm an apartment syndicator as well. And so I was asking John about exactly how to do this. And that's why he was like, well, Stephen is in your line of profession. Exactly. I was like, so if my husband gets one and my kids get one, and can they invest in the syndications? And he's like, get on this webinar.
they can. And so what's great is, so I'm on the GP side of it, right? And my whole
Yep.
family's on the LP side.
Yep.
So, and then sometimes I'll invest as both, right? So I'll put money in on the GP, and then I'll also go in on the LP side through my life insurance policy.
Okay, so it doesn't have the same rules like with a self-directed IRA. You can't have a first degree family member, but life insurance doesn't have that limitation.
Exactly.
Okay.
And that's the whole reason that we have those all set up for me. I started doing that for flips because what I hated about flips was I couldn't fund my own flip through my retirement account.
Right.
Right. Because it would blow it up. So when I found IBC, I was like, oh, this is perfect. Right. I get to kind of do all of those.
So Sarah, everything you know about the self-directed IRA and all the qualified plan rules about arm's length transactions and all that other nonsense
goes away.
Yeah, cool.
Well, I just log into my insurance contract, say send me $100,000, and they send it, and then I deploy it wherever I want. So Dave's gonna get into that, but
yeah, I'll walk through an example. That was a great question. It's like you teed it up for me, so I can just.
It's a plant.
Yeah. Yeah.
So real quick, we'll talk to Adam Bauer. He said, how do you source your deals and find your investors? So first thing you need to know about me is we are highly favored by the creator and how we find our deals. I'm not kidding when I tell you we literally pray over every deal that comes in, and we've closed almost 80% of the deals that we underwrite, which is not typical for a syndication, right? If you talk to people, typically they're underwriting about 100 deals to get an offer accepted on maybe one of them.
Yep.
So that has not been our experience. In the last 18 months, out of the deals that we have actually put pen to paper to and underwritten, we've closed or gone under contract on 80 of them. So we're just blessed and highly favored. But how do you find your deals? So first you got to pick a market, right? So we're in Orlando because our partner lives there, and he was finding deal flow for the self-storage facilities. Self-storage in Florida is a big game. The national average for self-storage is 85% occupancy. It's like 93% right now in Orlando with new stuff coming online every day. The reason for that is it's the second fastest growing city in the country for the last 3 years running, and it's got a real high water table, so there's no basements, right? So people need a place to store their stuff. And we've been able to do 3 different facilities there. So we did the first one, and our partner found the deal. And then the bank came out to do the appraisal and do the SWOT assessment, which is kind of what the opportunities and threats are in the area. And literally we were 4 weeks behind schedule on getting the appraiser out there because we had these gopher tortoises that needed to get moved off the land. And these gopher tortoises held us up for a month because you can't move gopher tortoises unless it's 60 degrees or higher for at least 3 days. I'm not making this up. So it was a cold snap in Orlando, so it didn't have that 3-day run rate for a couple weeks. finally we go out there. So it holds up the appraiser. By the time the appraiser goes out there, the guy across the street puts a big sign that says 100,000 square feet of rentable self-storage. So they came back to us and said, hey, we need another $1 million in interest carry. And we expect that it's going to take 24 months instead of 12 months to lease up now because of the competitor across the street. So we went across the street and we asked the guy how much he wanted, and we paid $2 million for his piece of land. So I either need to give a bank $1 million or I can go buy it across the street. And we did, and that became a luxury RV and boat storage place. It was a great complement to the building that we were already doing. Boat storage is a big deal down in Florida as well. So it really worked out well. The third one was a third storage facility. Yeah, they're huge too. They're big. Those big tortoises. So the third self-storage facility came not too long after that, and it was another one down the street. So he was there, right? He was getting, once you do a deal, if you listen to the Michael Blanc podcast, he talks about the law of the first deal. He's a great multifamily syndicator as well, and he always talks about this. He's got an education company too, but he talks about the law of the first deal. Once you do your first deal, it's like deals just start coming to you, right? It's because you have credibility in the market now. So the first deal was difficult to do. And that's why we partnered with a skilled operator and said, we're gonna bring the money to the table. We're gonna learn from the inside out how to do this business. And now we closed 66 units in Columbus, and somebody called me and said, hey, I have a deal in Columbus for you. It's 220 units. And then somebody called and said, I have a deal for you. It's 84 units. These are all off-market pocket listing deals from relationships that we built by being boots on the ground when we go out there. So that's how we find our deals. It's really through relationship, and you have a couple of days to move on a deal before they put it out to the rest of their list. And we just do our best to be authentic and transparent about whether or not we think we can execute on a deal or not. And then they test you. And if you pass the test, then you'll have more deals coming to you. So right now, deal flow is not a problem. We have deals that will close from the time the pandemic lifts, a deal a month for the next 6 months after that. So deal flow is not our issue. It's
now you need money.
It's money. It's always, we'll run out of money before we run out of deals. So that's the answer to the first part of your question. And then how do you find your investors? So I'm the only real capital raiser in our business. Most of the other guys do operations and underwriting and things like that. And it's really just relationship, right? It's spreading a wide net. It's getting on calls like this. It's going out to networking events when we're not in quarantine. It's speaking at some other events, and just kind of the podcast is starting to bring some traffic our way too. And luckily, we're partnered with some really smart people that know a lot of other people. So and your investor base, right? So we have about 87 active investors with us that have deployed about $17 million in capital with us. Those people are, that's our referral base. Once you send people quarterly checks for a year and you call them up and you say, hey, do you know anybody else that might be interested in getting quarterly checks like you are, passively and tax-free? They say, oh yeah, you know what? I was talking to my brother at Christmas about you and he wants to talk to you. So it's really just, it's long-term relationships. And because we were in some masterminds before this, we built some really strong relationships.
Do you have a minimum request for funds?
We don't. So it varies.
For investments?
Yeah, so it varies per deal, right? Some deals are smaller. Like we're under contract on a $3.1 million deal right now. We're also under contract on a $28 million deal. Those minimums will be different, right? So it just depends. And like I said, it depends on that unaccredited versus accredited structure, because the unaccredited, if you do a 506B, the SEC says, okay, you can have unaccredited investors, but they cap you at 35. So hypothetically, let's say I'm raising $3.5 million. If I only can have 35 unaccredited investors in there, and they're all unaccredited investors that come in, then the minimum would be $100,000. On the last deal that we did, a guy wrote us $1 million check and we were only raising 2.7. So there was a couple people like my daughter who got in under the minimum typical requirements, right? It was $13,000. It was a little light, but we let her in because she's 6 and adorable. So that's the short answer to that question. So do all your deals require multiple year inputs? So we set the expectation, right, that it's going to be anywhere from 3 to 7 years, depending on the deal. So the self-storage facilities, we're turning that capital over in 3 years. You create a lot of value in ground up development. So that's how we're able to do that. Typical deal is 5 years. And a 5-year hold is because it takes time to turn these tenant bases over. It takes time to roll new net operating income into a higher arena, and then also decrease those expenses. So sometimes the question behind that is my money tied up for that long? God forbid something happens to my family, right? And I need that money back. So, we're a small owner. We're a small owner operator. We're family owned and operated. There's 4 of us in the business. We're human beings. If something happens where you need that money back, in the operating agreement, it just dictates that we are allowed to buy your shares back first before we bring in another investor. So it's not as liquid as the stock market, right? I can call my stock market guy tomorrow and say, give me all my money, and he's going to give me all my money tomorrow. What we ask for typically in the operating agreements is 60 to 90 days for us to replace your capital if you need it. And that's just because we don't know exactly where we're going to be at during that time frame, right? So I don't know if that was an underlying question with that, but a lot of times it is, because people feel like they're getting into these deals and then they're handcuffed into the deal. And we understand that people might have a life event where they need to get their money back out. The operating agreement just dictates that. So when you invest, by the way, you're buying shares of a company that own the underlying asset, right? So you actually have an asset. It's just shares of a company. So you can sell those shares back to us. And if we say no, then, you can call somebody else and say, hey, I have these and I need my money back out, but get in this investment. It's a good one, whatever. Piggybacking off Adam's question. Are you good? Did that get you? Yeah. Okay. When you reach out to private investors, what's the typical smallest amount of capital that's useful for your average deal? So, on average, over the last $75 million, it's been about $100,000. And like I said, it's varied down to 13 all the way up to $1 million. Our biggest investor that we have, he puts $1 million into almost every deal that we do. So, what else?
Well, hey, why don't I take it from here? And then as the questions keep coming in, we can answer those. I would kind of want to walk through. I like Sarah's question on, a lot of us on here, I just know from knowing you all personally, knowing a lot of you, that you use life insurance as a savings vehicle and investing, not as an investment, but you use money inside your policies for investing. So I was going to walk through just a scenario using the numbers that you just mentioned. And we'll use, Paul Fougere there as an example. And I'll walk through this. And Paul, if questions come up in the chat box, maybe you can answer them while I'm doing this.
Gotcha.
Let me get rid of that. So I'm going to show you. Let's see. So Paul and I and several people on this call use life insurance, right? That's where we store our money. Your money has to reside somewhere, right? We just choose to put it in what we have found to be the most efficient and effective place to grow our capital while we're not using it and while we are using it. So here's an example of how Paul's going to use his, and then I'll show you how, Stephen mentioned as an example, a 12% return, simple return on investment. Well, in this case, Paul's going to get 140% return on investment. So stick with me here and I'll walk through this with you. So like I said, Paul here, this sexy man with the aviators, he's got, $100,000 in cash value inside his life insurance policies. So he's going to go to the life insurance company and say, hey, I want that $100,000. And what the insurance company, they're going to loan him $100,000 from their pot of money at 5% simple interest. And they're going to collateralize that loan against the cash that he has inside of his cash value policy. Everybody follow me so far? So he's not actually using his own money. He's borrowing money and then collateralizing it against his own money. So Paul's going to take that $100,000. He's going to give it to Steven, invest in these apartments. And like Steven said, every year he's going to pay $6,000 back to Paul. So 6% annual return, paid quarterly. But $6,000 a year going back to Paul for 5 years, right? Paul's going to take that 6,000 and he's going to send that check right back to the life insurance company. So he's going to pay his interest every year, which is $5,000. And then he's going to put $1,000 towards principal just to start paying that loan back. Follow me? And specifically Sarah, because you had that question specifically, so I want to make sure you're following along.
Yes,
okay,
thank you.
cool. And then at the end of the 5-year term, say this was a 5-year term, the investment's going to pay back Paul his principal, so the $100,000 plus another 6% simple interest that's been accumulating and accruing for that 5 years, so which is another $30,000, right? So Paul's going to get a check for $130,000. Now he's already received $30,000 over the last 5 years from the investment. Now here's another 30, so that's 160,000 total. So Paul's going to get the 130,000. He's going to owe 95,000 on the balance of his loan with the life insurance company still. And then the remainder, the 35,000 is going to go back into his life insurance policy. He's just going to throw that on top with a premium payment or something like that. Okay. And all the while, his money, that original $100,000 has stayed inside that policy. It's never been touched and has continued to grow, compounded for that entire 5 years, earning interest and dividends, and growing tax-free inside that policy. So you could estimate it probably, by the time he puts that money back in, it's probably that $100,000 is probably about 120,000 now. And he adds the other 35 on top. So that's how borrowing against your life insurance and using life insurance cash value to fund an investment works. Now, where did the 140% come from? Return on investment is your net profit over cost of the investment itself, right? So if we say his original investment was whatever came out of Paul's pocket, the only money that came out of Paul's pocket during that transaction was the interest he paid to the insurance company on the loan, right? He didn't use any of his own money for the investment. So he paid $5,000 a year in interest for 5 years. So $25,000, that's his cost. And we can consider that his original investment. He received $60,000 throughout the 5 years on that investment. So 5 years. So now return on investment is his net profit, which is 60 minus the 25, so 35,000 divided by the cost of the investment, which is the 25, the interest he paid. It gives you 140% return on investment. So what's pretty cool to look at is just the compound annual, a 19% annual compounded return. So, how many investments can you think of that offer you a secured investment? So it's secured by a tangible asset and tax benefits along with it, and get a 19% annual compounded return. 140%. And that's actually, this is funny because Paul's got another investment where he's doing the exact same thing. And do you mind me sharing what your return? Yeah, it's going to be something like 700% return on investment.
Yeah, it's cost of money. It's a $60,000 investment, again, through life insurance. So the cost of money is $3,000. It's a 12-month investment. So the cost of money is $3,000. They're paying me $24,600 in interest. So it cost me $3,000 to net $21,600.
So it's just the power of having your money work for you in two places at once, using other people's money, OPM, right? Anybody who raised their hand and said they read Rich Dad, Poor Dad understands other people's money, and that, to maximize your wealth growth, using other people's money is essential. That's how you get 140% return or 700% return on your investments all day long. So yep. Hope that answered your question, Sarah.
Yeah. Can I ask more questions?
Yeah, absolutely.
Oh, yeah.
Cool. So if my LLC, Sugo Capital, is going to be the investment vehicle, and I have a life insurance policy for 4 people in my family. So would that Sugo Capital would borrow from the 4 life insurance companies in order to make the one investment into the syndication? Is
So
that how it would work?
your money, that money in your life insurance policies can be used. There's no restrictions whatsoever on how you use that.
Mm-hmm.
So if
So you could
you,
do it as 4 or you could do it as 1. So we just pooled our families together into one family investment. And then when it comes back into my bank account, I redistribute it back into the policies. But it's really up to you because it's not like an IRA where it's an IRA number and the syndication has to pay back that specific IRA number for the benefit of Sarah, right? It's it's just a loan against it. It literally, when you call for a loan, they wire it into your personal bank account. So there's no need to do more than one set of paperwork.
So it could be a loan. Well, I'm trying to see if it could be a loan to a company versus a loan to a person.
Anything.
sure.
Okay.
Yeah. In fact, I mean, I'm not a CPA. I'm not an attorney, but you can loan, that's your money, your personal money. You can loan your own money to your company, right?
Yeah, that's what I would want to do.
And charge interest.
Yeah.
More
So-
interest.
Yeah. So your company could pay you interest, which, as I understand the tax code, that's a tax deduction for your company. And then your company invests over here and then gets paid back, and then it pays you back and you pay your policies back.
Okay.
So you got to keep really good records for that and talk to obviously a professional. But yeah, the things you can do, it's just, you can get really creative, and there's no restrictions.
Okay, cool. John, I think I'm going to need 4.
Deal. And just to clarify, Sarah, I think what you were trying to ask is, were you asking if the life insurance company would lend your company directly the money? Is that what you were trying to differentiate between
Yeah.
what those steps were? Yeah. So
Yeah.
I think everybody on this call would agree, and correct me if I'm wrong, you want the life insurance company to lend you personally the money from your personal life insurance policy, and then your personal life loans your business the money from your personal
Okay.
economy, so to speak,
Okay.
or your personal
Mhm.
financial system. Anybody
Okay.
disagree with that?
Yeah, spot on.
Right on.
Okay.
And
Cool.
some of the reasons we want to do it that way is we want to keep that life insurance policy a private contract. It's not anybody else's. It's not part of your business. Doesn't get reported anywhere. And so as long as that's happening, that's a much better situation.
Okay. Cool. Thank you, guys.
Yeah.
That's awesome.
Yeah, and one thing to consider as well, Dave kept the numbers on this example extremely simple, right? What it doesn't really show is that from all the deals that when I leverage my cash value, all of the profits from those deals, I literally I don't pocket some of it and then pay some to the insurance company. I flow 100% of my profits, and including my saving money that I used to put in savings, and I flow all of that money against the policy loans so that 1, I'm ready for the next deal quicker. And number 2, I'm actually lowering the volume of interest that I'm paying. Because if you know HELOCs, home equity lines of credit,
Yeah.
interest only ones, the interest is calculated in average daily balance. These things are no different.
Yep.
Awesome.
Yep. It's seriously the best asset ever. I mean, honestly.
I don't have the chat box. For some reason, I'm not able to get the chat box back up. So I don't know if there's any other questions, but does anybody have any questions or anything to add to the conversation? I want to respect everybody's time again, but I'm happy to stay here all night, honestly.
Yeah, love it. Now there's no question in the someone that I know is asking who John Perrings is. So maybe John could tell us a quick 60 seconds about himself.
Wait, what's that? That's me.
Yeah, we were just wondering who you are. Is one of the questions in the chat box.
Oh, I didn't see that. I would have answered it.
Wondering who the rest of you are.
yeah.
I know John.
No, it's private. It's private.
Yeah, Dave Befford and I know each other through Infinite Banking. So we met for the first time last year at the Infinite Banking think tank, which is the annual gathering of IBC practitioners to get together and talk about strategy for the following year. And then through that relationship, we joined the same coaching group, working with a guy named Trent Fortner, who's been in this business for 30 plus years and has done a really good job. And so we're basically part of a group of, I don't know, 50 advisors right now that all have a similar mission in terms of bringing more control and certainty into people's financial lives. And one of the common threads amongst that group is we all work with, a good amount of real estate investors, because quite frankly, real estate investors just get this concept much more quickly than a lot of other people, business owners, real estate investors, other types of investors. So I'm in Oakland, California, and there are a couple people on this call. Sarah is here because I invited her, and then there's another guy named Adam who's a client of mine out of New York and is also a real estate investor. So I just thought this would be great for everybody, for my people to join and learn from you guys. So I really appreciate the insights that you've offered. I was going to quickly add one more quick thing about the loans, something that's important to understand about the loans. And you mentioned that they're calculated on an average daily basis. Well, the other thing that's important is their charge, the way that insurance companies charge interest. Well, they actually do it in different ways, but they'll come about it. Most of them will end at the same result, is that the interest is charged in arrears. And so it's not like an amortized, it's not an amortized loan where they're charging you the interest up front and then you're paying that back. So if you have a $100,000 loan out and you're making regular payments back to that loan, your principal balance decreases over the course of that year before the interest is charged. And so what ends up happening is you end up with a lower net interest rate than what you would be charged with a typical bank loan, right? So it's another I think a super important piece to understand about life insurance policy loans and loan interest.
Yeah, great point, John. A lot of folks when I'm getting into IBC with them ask, "Oh wow, they charge you 5%. I can go to a bank and get 1.9." And I tell them, when you look at the volume of interest, even on a low interest rate commercial loan from a bank that's amortized versus a simple interest loan like you just talked about, it is so different.
Yeah, volume matters.
Yeah. And here's something that not everybody will completely agree with, but answer this question: what's the going market rate of interest for a bank loan with no payback terms? And so, obviously we want to pay attention to the interest rate itself, but man, I tell you what, wouldn't it be, if you're sitting somewhere, let's pretend for a second that you had enough capital to just fund all of these things directly with your own life insurance capital and never had to worry about making a loan payment. How much flexibility would you have during some of these down times when people are not paying rent, all of those types of things. So, I'm not saying it always makes sense to pay 5% over 1.9% or whatever it is, but man, it's something to put into the equation.
Well, and to your point, right? So I'm doing that right now as an operator, and the fact that I want to be a good banker, right? I want to pay myself back in increments so that I can reduce the volume of my interest, even on that simple interest term. But yeah, if I'm only running we took in 78% of our rentals that were due in April. And luckily that clears the hurdle for my debt and equity investors. So we're good on that property, but we don't know what, maybe May looks like. Right. Well, if I fall to 45% of economic occupancy, then I can't make that payment, but I don't have to pay my life insurance policy back that month, right? It's not a fixed, I don't know if anybody's actually said this, but it's not a fixed payback schedule. Like you showed Paul paying himself back over a period of time during the loan because he was getting the money back in. But he didn't have to. He could have waited until year 5 and he could have put 160 back in. The result would have been a little bit different because it didn't calculate the year by year, right? Of what.
Right.
But that's, to me, and for you, Sarah, and for anybody else on the call that wants that type of flexibility, during times like this, your 401k doesn't give it to you. Like for real estate investors especially, this is the best product that I've found out there to give you the flexibility that you need for payments and also the security. I mean, if we're not going to be cash flowing one of our properties this month because people aren't paying, I have another policy that I haven't touched yet that will have $100,000 in it that I can pull down expenses from. Right? It gives you just kind of that extra safety and security, and I can access it whenever I want and pay it back kind of whenever I want.
Yep.
So, Stephen, if I have two more questions, one for you, one for, I think it was Greg. So when when your daughter invested, did you invest in her name as an LP, or did you?
Yeah.
Okay, you usually do like individuals versus, so I'm on the GP side, but so I was kind of thinking like structurally, do I take the loan and invest as Sarah Sullivan or invest as like all my daughter's names?
So for that deal, I just did her alone. For the next deal, I'll probably combine all three of my kids into like a children's trust account, just because I hate accounting. So I just want everything to flow into one, and then I can disperse it as I see fit.
Yeah.
But I did it, I opened the bank account right in her name, and me as the, I don't know what you even call it, the administrator.
Yeah.
So the checks will actually go back to her in her name. And that's part of like the just financial training that I want to have for my kids. She'll be 6 and 7 as she's getting these checks in, and we're trying to teach her about what investing looks like. So that was why I did it for that. But in the future, we'll probably combine them into one just for tracking purposes for it to be easy. But you can really just do, it's completely up to you. There's,
cool.
no rules to it.
My daughter is 6, 7 in 2 weeks, and like as part of the homeschooling, we have economics and finance, and my husband's like, oh my gosh. But yeah, it's
awesome.
important that they learn
That's
young.
awesome.
So I think it's really cool.
Yeah.
Thank you for that. I didn't know about any of this, so I'm really excited.
Yeah, it's awesome.
If I can ask another question, it was about when the PowerPoint was up. I think it was Greg. Were you the one who was speaking at that point?
No, it was me, Dave.
Oh, Dave. Sorry,
Yeah,
Dave.
Yeah, which slide do you want to see?
It was like, I guess it was the example with Paul. And so it shows the money going back into the cash value life insurance contract. I took a screenshot, so that's what I'm looking at. But then isn't there also a piece of it where you're earning money, earning interest during that time from the life insurance company? Maybe I missed like where
No,
that is shown
absolutely.
in the...
Like I said here, this money right here, I don't know, can you see my cursor?
I can't see your screen.
Oh, okay.
Oh, there it is. Okay, sorry, I just need to switch.
Okay.
Okay, yeah.
Yeah, his money is sitting inside his life insurance policy completely untouched. Once you put a dollar in there, it's locked in for life and it never comes out. And that's why you collateralize that money and borrow from a separate pot of money that the insurance company has. So all that while, yeah, this money is over there still earning compound interest and dividends on a tax-free, tax-deferred technically, but tax-free effectively basis for life. So that's the beauty of it, is that you have it working. Every dollar is given more than one job. So you don't lose any opportunity cost. So yeah, we didn't even calculate what the return would be, considering that this money right here is still growing. It would be, much higher than 140%.
Yeah, because if you're getting 4%, but you're paying 5%, yeah, makes a huge difference. Okay, cool. Thank you.
Yeah.
Yeah, and Sarah, you'll hear this, but you can withdraw money from your policy eventually. Could be a taxable event. If you're and once you understand infinite banking, the infinite banking concept, you will always access that money via policy loans. I think a withdrawal there would have to be a really special circumstance where you would, I think, want to do that. I'm going to pay premium to the day I die, and I'm going to access that cash through policy loans always.
Okay, cool.
Cool.
I appreciate that you guys explaining all this, and I appreciate you inviting me, John. Thank you.
Yeah, this was great. Good job, guys. It was
Thanks. Hey, I would say
super insightful.
if anybody has any questions, whether it was me who invited you or Paul or John, if you have questions about, potentially wanting to talk to Stephen more and investing with him, or just questions about it, or learning more about infinite banking or insurance policies, contact one of us, whoever invited you to this, and we're happy to answer your questions and put you in touch with Stephen. So, hey, Stephen, thanks a lot for your time, buddy. I know you're a busy man out there making deals, so I appreciate the time.
I appreciate you guys having me on.
Yeah.
Great stuff, Steven.
Yeah.
Yeah, one
Right.
disclaimer, this is not tax, legal, or investment advice. There, I said it.
There. Very good. Thank you. Thank you. I'll start my
Awesome.
presentations like that next time. All right. Hey, well, thanks everybody. And, I'll be putting stuff out there for maybe another call next week on a different topic. So stay tuned and hope to see you guys again.
Awesome. Thanks, guys.
Thanks, Dave. Great
Right.
job.
Thanks, guys.
Thanks, guys.
Appreciate it.
You're welcome.